Hello, everyone. Glad to be here. So, why are we here? Uh, the cannabis industry is growing. Most of our clients are what are known as small and medium-sized business. They're getting close to $25 million in sales. This is not a cottage industry. And so it's time to relook at more sophisticated methods regarding dealing with taxation issues. So many of you who are on the line are aware that for tax purposes, only cost of goods sold is deductible for tax purposes. Um, we will discuss that a little bit in with the next presenter, but primarily we're going to be focusing in some changes to the definition of cost of goods sold based on the 2018 tax law. Okay, this is Abraham Finberg. Uh, so, so we discussed accounting procedures that are mentioned in Section 471C. But what is an accounting procedure? You know what? No one actually knows yet. And that's basically what Andrew was alluding to. So let's go back to the TIGTA that Andrew was discussing before. And so just to clarify, the Internal Revenue Service also gets audited. They get audited by the Treasury Inspector General. And they had a report. And so one of the items mentioned was that they asked the IRS to figure out what are the procedures to figure out an accounting procedure. And so the IRS's response was, well, you know what, we disagree. We don't think we need to deal with this right now because we're just too busy because of all the other different laws that have changed in the 2018 Tax Cuts and Jobs Act that we'll get to it eventually. Okay, so what that does open up is the issue that this has not, since the Internal Revenue Service has not given guidelines, and they haven't dealt with the issue of the fact that you no longer have to clearly reflect income, you have a lot more leeway. Now, the AICPA, which is kind of like a lobby group for accountants, so they like to tell the IRS what accountants would prefer to hear, and so they did actually respond to the IRS. And so what did the IRS say? So they basically said, you really basically don't need anything written down as long as you're consistent. Here's my concern, though. If you've been in the cannabis industry, you've probably been bought out for a few times. You've probably unwittingly changed your accounting method. You've had you've gone from, based on tax court cases, you've been presenting your books in different ways again and again and again. So can you consistently show, a process? Especially, we have a lot of new companies that they may have functionally been older companies that have been modified to match the current legal environment. Legal as in trying to get your cannabis licenses through the state. So a lot of people have very jumbled accounting records at this point in time. So what the AICPA also recommends is that, well, why don't you look at the journal entries? Look at the working papers, which is basically how, if I put a number on the tax return, how did I come up with that tax return? And the AICPA recommended to the IRS, maybe you should do it this way. And of course, the IRS said, they didn't directly tell the CPA, but their response has been, we're not going to deal with this at this point in time. Okay, so so the thing is, you're left with journal entries, working papers. Also, the IC mentioned a profit and loss. The thing is, how, when you're in front of an audit, how do you make yourself seem more authoritative in terms of how you present yourself? It's better if you have an actual procedures that's spelled out. That this is how we define capital. This is how we define our inventory. Our inventory is going to be lower of cost of market. Our purchase costs are defined in this way. It's better if it's all written out, so that this way you can explain how you came up with your decisions. It's a little easier. Imagine you're in front of an auditor. The auditor's job, I know this is going to be shocking to most of you, but the auditor's job is basically to accept all your revenue, get rid of all cost of goods sold, and all deductible expenses, as a matter of course, unless you prove them otherwise. That's why we had the 16th Amendment, so that you could do stuff like that. You're basically guilty until proven innocent. So the question is, can you show something that is consistent, that is easy to follow? Okay, so please go to the next slide. And then, okay, so why will accounting procedures work? As Andrew mentioned before, they have to work. Because the IRS has not been able to respond to Section 471C disallowing accounting procedures. And so this is why the accounting procedures have to work. Okay, so go to the next slide. And also go to the slide after that, and I'll respond back to this specific slide. Okay, so here's an option that we have. Okay, so what you could do is you could write your own accounting procedures spelled out. Another option is you can actually issue a set of financial statements that show your profit and loss, show your balance sheet, also show a statement of cash flows. And they also include notes as to how you came up with the numbers. And it does say prepared by CPA. Additionally, if you want to report to make it sound more authoritative, you can also have a report called a compilation engagement, which is signed by a CPA. So at least you have, if you're going in, you have something in the notes of the financial statement. Okay, now for people who have worked with me for a number of years, you know I like to say the phrase, I'm a lousy salesperson. My goal is not to get you to create an extra financial statement so that we have more business as a CPA firm. Believe me, we're really, really busy. Obviously, we're happy to create compilation and preparation engagements. We're just pointing out, here are some possibilities that you can do if you want something that looks a little more authoritative. If you want it to be really authoritative, there is something called an audited financial statement, which is not only is the audited financial statement signed by the CPA, but they actually give an opinion. Yes, these numbers are correct. Or sometimes these numbers are correct except for. Now, the problem with issuing audited financial statements is that these are, for tax purposes, known as applicable financial statements. Okay, so applicable financial statements have to follow generally accepted accounting principles. So generally accepted accounting principles, they require um, certain indirect costs that have to be moved into cost of goods sold. And when I say indirect costs, I mean labor, overhead, utilities, um, things like this, payroll tax. So that might be good. And the problem is, and Mona, please go to the next slide. Okay, and the problem is remember, Section 471C allows you to use your own accounting procedures to determine what cost of goods sold is. You don't have to use a specific trade or industry to figure out cost of goods sold. You don't have to use generally accepted accounting principles. And so let's say you wanted to confirm that you wanted to use Internal Revenue Service rules regarding immediate depreciation of capital assets. So let's say you spent $1 million on a build out for a cultivation warehouse. So you spent $1 million. So in any other industry, you would be able to use what's known as a Section 179 expense. And so that $1 million, instead of taking that $1 million and parsing it out over 39 and a half years, so that would be like, like 40,000 a year for 30 and a half years, you could take the full $1 million as an expenditure in the tax year in which the warehouse is ready for use. Okay, so I'm sorry, I'm hearing someone in the background. Please mute your mic. Thank you. Okay. So if you use your accounting procedures rather than what's known as an applicable financial statement or audited financials, you have that latitude. You can make that decision. Now, I'm going to get into something even more aggressive, and I recommend do not do this yourself. This is definitely, you want to work through the pros and cons with your accountant. The funny part is you could throw in to cost of goods sold things that are not normally cost of goods sold by any stretch of the imagination. So it's fairly easy for me to explain why, if you build a warehouse, that should be part of creating a product. That would be fairly easy, especially labor, utility, electricity, obviously buying the product. What's really hard is, let's say I want to throw in marketing. Marketing does not create the product. Can I do that? Well, what it looks like, and this is really, I'm not giving you advice. We really need to talk about the pros and cons of this on a case-by-case basis. Technically, you could. Now, it's a very aggressive approach, but this is definitely something that you could do. Basically, any expenditure you had potentially could be cost of goods sold. And so this really opens up quite the possibilities in order to regarding your the way in which you present your income taxes. Okay, so what I wanted to do, I have just a little bit more time, and I wanted to discuss Section 471. And I know it's not on the slide deck. It's because this issue has been discussed in other webinars, but I figured since we have a few minutes, I just wanted to clarify something. The 2018 Tax and Jobs Act has also provided the basis of using 471C requires that your revenue for on average for the past 3 years was $25 million in sales or less. Okay, so here's the thing. $25 million in sales, 3 years ago, if you told me $25 million in sales, that's no problem. Almost, very few cannabis companies are reaching $25 million in sales. But you know what? This year, especially, I have clients that they're definitely going to show more than $25 million sales. Okay, so I'm going to go just a little off topic in the next 2 minutes to say, in California specifically, the way the law has been written regarding the dreaded excise taxes for retailers, the tax in theory, or according to the law, is something that you have to charge the consumer. So the consumer, you sell a product for $50, that 15% excise tax includes that amount in that final sale. So that means for a retail who thinks they have $25 million in sales for sales tax purposes or city tax purposes, for IRS purposes, because of Section 164A, you in fact actually might have less than $25 million in sales because we can reduce your revenue by that amount, according to Section 164A. Now, do we have a tax court case regarding this? No. We do have a private letter ruling for a similar discussion regarding the Washington State, the old style taxes that they had. They also happen to use the term excise tax, but it's a little different than what we do in California. And the IRS did agree that if you pay this type of tax, that it's a tax when you sell something, you can reduce your revenue by that amount. And if there's a tax when you buy something, you can you also have a reduction of your gross income by that amount. And so Section 164A combined with Section 471C, the vast majority of the cannabis clients would probably still be able to qualify and take advantage of the 2018 Tax Job Act.